Yesterday was the best day for the S&P 500 in about a year. Today, the S&P is doing not a whole lot. You're up 0.2% at the time of recording this video. But there are encouraging signs for the bulls that this, what looks like a rebound rally, could continue. I think yesterday made it unequivocally obvious to everyone all economic data is important. Even your initial jobless claims that come out every week. Because that's what caused the S&P to have its best day in over a year, was initial jobless claims coming in 7,000 lower than expected. And if you guys want my total honest opinion, the only thing that matters here for markets is economic data. With that said, the Fed is still important, inflation is still important, geopolitical tensions are still important, but as long as nothing is a systemic risk to the United States economy, then it's all about economic data, because there is still quite a bit of fear out there. Which does become obvious when you look at the VIX that is still trading at 21.3, which is higher than any other period within the past year. Fundstrat writes on X, quote, 2 steps forward, 1 step back. As shown below, healthcare in equal weighted terms, RYH versus the equal weight S&P, the RSP, broke back above prior support lows in this ratio chart going back since 2021. Fundstrat also says growth looks compelling versus value. As this larger chart shows, the technical pattern remains quite compelling at current levels from a risk to reward perspective. Basically highlighting that the Russell 1000 growth still looks good from a technical perspective, and you can actually see a little bit further of a breakdown here before you actually break the upwards trend. I would say this is more of a support line than an actual trend line, but it is trending slightly upwards as well. And Tom Lee says evidence is growing that equities made their summer lows on August 5th. Weekly claims strengthen the case that weak July jobs report was due to Hurricane Beryl. July CPI next week matters. We are now 3 days post Tokyo Black Monday, and equity markets managed their best close this week, with the S&P 500, NASDAQ 100, and Russell 2000 gaining 2.3%, 3.1%, and 2.4% respectively. So as Tom Lee says here, equities have made their summer lows. Let me know your opinions on that down below in the comment section. Is the bottom in or not? And I have to say the argument is compelling that we have at least hit a short-term bottom, considering how the S&P 500, I'm using the SPY, is trading around this 100-day moving average. Yesterday you closed above it after finding resistance the prior 2 days at it, and now today you found support on our downside move right at the 100-day moving average, and you bounce back up to close near the high of the day. That's a pretty dang good sign that at least we have some momentum at our back to maybe even ride up to the 50-day moving average in the short term. That would still be upside from here of almost 2%. But do I think we're going back to new all-time highs anytime soon? No. New all-time highs for the S&P is about 6% higher from here, and I simply don't think the economic data is going to come in good enough to support new all-time highs. Next week, we are going to have lots of information and data coming out. Consumer inflation expectations Monday, some bond auctions, monthly budget statement as well coming out Monday. On Tuesday, you have PPI month over month and year over year, as well as a speech from Fed Bostic around 1 p.m. On Wednesday, you will get CPI. Again, as long as CPI does not come in higher than expected, then I think we're good. As long as it comes in line with expectations or lower than expected, I don't think CPI is much of an upside catalyst at this point for markets, considering the last 2 months have come in so good and well below expectations. I think the markets are pretty convinced CPI is no longer a problem, or inflation in general is no longer a problem, and it's only a matter of time before we are getting closer to the Fed's 2% target. The biggest catalyst of next week could perhaps be on Thursday with retail sales month over month. We're expecting positive numbers. Last month, we were at 0%. So from 0% to positive, that's growth. That's good. That data will come out at 8:30 in the morning on Thursday, and I think that is what gives markets the biggest move, higher or lower. We also have initial jobless claims, New York Empire State Manufacturing data, continuing jobless claims, export prices, import prices year over year, and Philly Fed data, industrial production, capacity utilization, business inventories, all kinds of different things. Even Fed Mausoleum that gives a speech, as well as Fed Harker that gives a speech throughout the day on Thursday. So Thursday is the big day of next week. On Friday, you will have building permits, preliminary numbers for July, and Michigan consumer sentiment, which will also be quite a big catalyst Friday at 10 o'clock Eastern Standard Time. The reverse repo market is also starting to fall even more, down to 312 billion as of today, including 62 counterparties that totaled that number. As James E. Thorne on X says, the yen carry trade unwind is coming to an end, global liquidity is increasing, and global reflation trade stands in front of investors. Invest wisely. Keep it simple. So with the M2 money supply that is actually starting to now go into positive territory, yes, only about 1% positive year over year. Some people are concerned about this reflation. I don't think inflation is coming back anytime soon. US credit card debt has also hit a new all-time high of 1.14 trillion, as bar chart says. Congrats everyone, we did it. Now back to the money supply chart. You're again in expansion territory, and usually when the money supply is growing, that is good for asset prices. Historically when the money supply does shrink, that is a bad sign that you're actually in a recession or going into a recession. Now, about halfway during some recessions, at least in recent history, you have seen the money supply increase, like the dot-com bubble, like '08. But it's really after that where you see another rise in the money supply that asset prices themselves start to do well. So in simpler terms, the money supply now increasing again could mean more liquidity, and that could mean higher stock prices. Which, I mean, just look at how well markets have done in an environment with the money supply actually negative. Now just imagine if the money supply does keep going positive and gets better and better. I would think that would mean a broadening out of our markets and some interest rate sensitive small caps starting to perform and at least keep pace with the mega caps. But I will say, if we ultimately avoid a recession and rates go back to, let's call it neutral, around 2.5%, I think small caps are really gonna have their day. As Mike Zaccardi says on X, equities tend to perform well after the Fed cutting cycle starts, unless growth is weak. And that's why the economic data is so important right now. Because it really doesn't matter if the Fed is cutting rates. That's not what tends to impact equities. Whether the Fed cuts a lot or a little bit, it does not matter. It depends on economic activity. If the Fed is cutting with good economic activity, then stocks will do well, simply put. If the Fed is cutting into a weakening economy, then stocks will not do well. And it's literally that simple. And as the markets are pricing in a 52.0% chance of a 50 basis point rate cut September 18th, between now and September 18th, we want to know, is the economy weakening or is it not? And that's why I think inflation and to some degree the Fed, they really don't even matter at this point. Unless the Fed were to get hawkish out of nowhere, which is not going to happen. Very low likelihood of that. Or if inflation comes in hotter than expected. And I think that's a pretty low likelihood as well. So at this point, it's all about economic data. Seth Golden writes, if you think this is what rail traffic looks like going into recession, the data is informing you of your error. This is not what even a softening economy looks like, with total traffic up 5.7% and total intermodal units up 11.8%. This is official U.S. rail traffic data from the 31st week of 2024 that ended on August 3rd. You do have total traffic year to date that is up about 3.5%. Matt Serenamar, RO, I have no idea how to say that last name, writes on X, the 2-year yield is now 1.56% below the Fed funds rate. Historically, this supports the beginning of a Fed cutting cycle, and it's usually at this point when the Fed does start to cut rates. Frank on X says SPX, that is the S&P 500, the beginning stages of short-term bullish formations are taking shape. Bloomberg's recession probability indicator based on 2s and 10s yield curve spread has fallen to the lowest since July of 2022. Seth Golden writes on X, the call of the year by Carter Braxton Worth. My hunch is the top is in for the year. So let's go ahead and play that clip from Worth Charting CEO that says, market sell-off has been so severe the gains on the year are almost gone.
A closer look at the technicals after a volatile week. Joining us now, Carter Worth, Worth Charting founder and CEO. Carter, great to see you.
Thank you.
So we've got the benefit of hindsight. So what do you make of the action this week?
Yeah, I mean, a couple things come to mind. The first thing, of course, is that as of now, it's all fairly normative. Let's just put it in context. We know that the high for now was the 16th of July, and this sell-off is 14 sessions in the making as of Monday's low, down 9.7%. Now, put that in context. There have been 241 instances in the inception of the S&P in 1927 where you've had a 5% plus sell-off. And the average decline is 8.2. The median is 11.8. So put those numbers in perspective. 8.2 down, 11.8, and this one's 9.7, smack dab in the middle of the average and the median. In terms of duration, 3 weeks. They typically last 3 or 4. But here's the issue, in my mind. That's average, medium. And typically, that's not coming from such a complacent setup, right? We know we'd gone one of the longest stretches in 15 years without a 2% move down or up. And because of the steep and uncorrected nature of the preceding advance before this 9.7% sell-off, my hunch is that this one will not be average or median, and just off we go to the races, that it'll be longer in terms of magnitude or duration.
Carter, what was most notable in terms of how the market sold off is that even so far this week, the Mag 7 have underperformed the S&P 500, the NASDAQ, their benchmarks like the SOX. What do you make of that as an underlying current within this sell-off and the ability of the markets to stage a comeback, so to speak?
That's right. So much capital is there. The hope was that this rotation, of course, would save the overall market in the sense that if and as money came out of the leaders, it is, that the money would go into smaller cap, into value names. It did. But those would hold their gains. In fact, the small cap stocks had given back just as much, the IWM, the Russell 2000, as the Mag 7 and others. And so the reset that we've had, again, while normal, my hunch is that because of the steep and uncorrected nature of the preceding ascent before this sell-off began, that we won't escape with just a normal sell-off. And just one other thing to consider, the sell-off is so severe at this point that basically the gains on the year are almost gone. Consider that the S&P is up, 11.2% year to date, but the performance of the average stock is up 4%, and the performance of the median stock is up 4.2. So again, the index, its year-to-date performance is still so driven by those super cap mag names, and those are the ones that still look as though they're under pressure.
Are they under pressure technically, Carter? I mean, do you think that there's anything in the charts that leads you to believe that they will continue to underperform?
Yes. So the circumstance that's common to most of those is that they all had heavy volume drops and gaps. So they have been weak with the market 2, 3, 4 weeks, and then news related, earnings drops and gaps. That happened in Microsoft, it happened in Amazon, among others, and we'll see about NVIDIA. But at this point, because of the severe nature of that selling, the aggressive and what you would call distribution, that's what the word is when you drop and gap and the volume's 4 and 5-fold. You don't get out of that, recover from that quickly. And so if and as those do work lower and the small cap have given back all their gains, or the so-called great super regional banks that were doing so well, all give back the gains. It doesn't feel like the setup for higher from here.
There's a lot of focus, no surprise, on NVIDIA specifically, Carter, particularly when a lot of the hyperscalers came out, reaffirmed or moved higher their estimates for CapEx on AI specifically. So, the fundamentals seem to be intact, but armchair technicians will look back to June 20th to a key reversal day for NVIDIA in terms of hitting a new high, then closing on the lows on very heavy volume. As a real technician, Carter, do you think we'll look back on that day and say that was a watershed moment? Because it really did sort of precede the sellout that we've been witnessing since the beginning of July.
Yes, those are very important days. They're key reversal days, and they happen, and you're citing it exactly right, on lows, and the market had one on the low of October of 2022. What it represents is there's a crescendo, either panic selling, which is coming on the heels of selling, in this case, panic buying. Something's going higher and higher, and yet at some point, there's no one left. And then intraday, almost like a child slipping from the chin-up bar, exhausted, out of buyers, no one's left, and it goes down and down and down. We are down substantially. Semi's down some 25% almost as an aggregate, and NVIDIA down. And so in many ways, what NVIDIA says will help encourage the bulls, but we're still so far down, it would take a lot to recoup those losses. My hunch for the market is that the highs are in for the year.
So I think he was pretty clear. He thinks the highs for the year are in. You've seen a lot of capitulation volume that did come in towards the lows on a lot of big tech stocks that had already rallied aggressively. I did find it notable where usually you would expect the areas that started to see the rotation, like small caps, be the ones that pull us out of this yet again. And that has not happened with small caps that are now underperforming big tech yet again. CNN's fear and greed indicator today is at 24. You're still indicating you're in extreme fear with market momentum that is fear, stock price strength neutral, stock price breadth is fear, put and call options extreme fear, market volatility is neutral, safe haven demand extreme fear, and junk bond demand that is also in extreme fear. You can also see 10-year Treasury yields today are trading down about 5.5 basis points to 3.94%. I find this interesting because what's been happening since we've actually bounced is 10-year Treasury yields have been moving higher as well. So today is the first day where markets are in the green again, and 10-year Treasury yields are actually down a significant amount. Every other day, the markets have been green and bouncing, including yesterday, our best day in a year. 10-year Treasury yields were actually trading higher. So this is a little different. The current estimate for Q3 GDP is 2.9%. The average analyst estimate for Q2 GDP is about 1.8%. So the Atlanta Fed is about 1.1% higher than where Wall Street currently is for your GDP estimate for Q3. Coming next week with imports, exports data, inventory data, we will get a new GDP update, so that can be significant for markets. And here on the day today, the percent of stocks currently above their 50-day moving average is at 44.57%. You're actually seeing 0.35% of all stocks breaking below their 50-day moving average today. So today, it's not a good day. It's not a terrible day for markets either. Even though indexes are in the green, Apple is up 1.18%, Meta's up 1%, Nvidia is slightly in the green, Microsoft's up 1%, Amazon's up 1%. This is really being led still by your big tech. So let me know your thoughts on all of this information down below in the comment section. What is next for markets in your opinion? As well as that, hit the like button and subscribe to the channel if you made it to the end of this video, because it's free 99 and costs you absolutely nothing to do so. You guys enjoy your weekend, and I will see you in the next one.